Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome to another episode of the Australian Retirement Podcast, where we bring financial and retirement goodness to you every Thursday.
Well played.
I'd like to welcome my friend and I wish I could say colleague for some reason, James O'Reilly. James, welcome.
Thank you so much. And pleasure to be here. We've got some ripper questions to go through today. This is going to be awesome.
Yeah, this is an amazing one. And this is like, I think these, not to say the other ones aren't enjoyable, but one of the most enjoyable parts is seeing the amount of questions that are coming through for every episode. And it allows us to go through, like sit here and answer 8, like hopefully 10 questions that can be helpful to not just the person asking, but to all the listeners, whether they're on YouTube or Spotify, Apple Podcast, anywhere you're watching. And we just keep encouraging people to send through questions and ensure that please anonymize them. Anything we say on here is going to be general advice only, nothing personal. So that way, if you have a fake name like Nurse Betty or Switcheroo Sue, it helps us, makes it easier for us to answer these in an appropriate and compliant way, I think is the key there.
You might have really upset someone whose real name is
Switcheroo Sue. Sorry, Sue. So the first one we got from, Switcheroo Sue, and she's asking the Shakespearean question of to switch or not to switch.
That is the question.
Yeah, that is the question. I can only assume, this is the first time I've ever got a link to one of these things. Usually you get the Zeitgeist link. And this one I can only assume she's talking about a superannuation fund. Mm-hmm. No, hopefully, let's assume it's a superannuation fund, not a bank account or an ETF. Or there's so many options you can switch between. So I'm sure you've got a framework through which you kind of consider these questions. What would you say to Switcheroo Sue?
Hey, Sue. Or hey, Switcheroo. We have to clarify that one. There's a lot of superannuation funds out there, and one of the wonderful things is that you can find the right superannuation fund for you.
Yeah.
But you don't always need to switch, and sometimes switching really isn't going to achieve anything. So if we're thinking about making a switch from one superannuation fund to another, there really are only a few reasons why you should do that. The first one, the immediate one, is that the funds are comparative and the fees are substantially lower. Lower fees, or high fees, are just straight up erode your returns. And if you're paying higher fees and not getting some meaningful things in as a benefit for that trade, well, then that's a poor deal.
Yeah.
That's an obvious one. That's very low-hanging fruit. Is this cheaper and can I achieve the same outcomes with my fund? If it is, then that's a great reason to switch. The second reason why you would consider it is when you start to dial into the features and the benefits of that specific fund.
Yeah.
So, for example, you might identify that there are some particular investments in one superannuation fund that are either more aligned to your investment preferences, they're more aligned to your ethical and responsible preferences, they're more aligned to your risk profile.
Yeah.
In that scenario, that could be a great reason to switch.
Yeah, for sure. I mean, there are multiple reasons, and the biggest one comes down to, as we know, there's 3 types of super fund. There's an industry fund, there's SMSFs, and there's this kind of corporate in the middle that's a little bit of both. For us, it's always about determining the appropriateness of that type of fund for each person. So a big one for us is, do people want control? And I found that it seems like in my experience, one of the reasons people gravitate to SMSFs and to even corporate superannuation as they get closer to retirement is they're looking for transparency. And transparency is being able to know what's driving every dollar of income they're going to get in retirement, or why their unit price is going up and down. So not saying that's suited to everyone, but basically if control and transparency is something you want, then this is one reason that you might look at switching to a different superannuation fund. But exactly the same, if it's going to cost you significantly more, that is always, it's a firm. And one of the responsibilities of an advisor is when they're recommending a switch between whether they're like for like or completely different, they have to do a review and a comparison of those fees and justify if it's even slightly higher. But if it's lower, then I don't think you really have to justify much. That's the nature of the legislation. But it's all about finding the most appropriate one for each individual person, I think is key.
Something that's really important here, Sue, is also around insurance. if you have proactively gone and arranged your insurances and they're exactly in line or aligned with your personal financial situation, that's wonderful. And that might mean that you're less reliant or indeed not reliant at all on the insurance, or you've cancelled the insurance inside your existing superannuation fund.
Yep.
So please, please, please do bear in mind that when you switch from one superannuation fund to another, firstly, your terms of insurance are likely to change.
Yep.
i.e. how much cover you have, and if there's income protection, how long is the waiting period and how much you're getting. Like, those things are really, really important. But the other real thing that can happen here is, depending on the insurance on the fund, you might have, for example, what we call pre-existing conditions where, for simplicity, I might have cover with Australian Super. I've got life and total and permanent disability and income protection. And because I've had the policy, I've had the super for a long time, it covers my body. Like, if anything goes wrong, I'm probably protected.
Yep.
Whereas I now have a really serious shoulder injury, and that's been causing pain for some time. I decide to leave Australian Super and I go to Rest, for example, just to name one. In that scenario, if I was to then claim on my Rest income protection within the first couple of years, they're very likely to say, hang on a second, that was a pre-existing condition when you came to us and we won't cover that. So, there's nothing worse. It's tragic to hear from people, and we do more often than we should, that say, I switched my super and as a result, I didn't realise the insurance consequences of having done that. So please be dialed into practically what that means.
Yeah, so exactly. I think, and one thing I'd say is that too much of the focus on switching can be on performance. Fees, fair enough. Fees, yeah, we understand. That's a direct impact on returns. But so much of it is based on historical performance, projecting that into the future and assuming that fund or that option is going to do what it did in the past. So if I was, any advice would be, don't rely solely on performance. Don't swap from the best fund to the best fund. It's like swapping from the best ETF, the best share, to the best share. It's a short-term view or mindset in my experience. And I think, as you mentioned, there is an opportunity where you can hold more than one. You don't. While it's not always the best, and there's actually legislation that stopped it happening for younger people, you can hold more than one super fund. So it is possible to say have an SMSF while also retaining insurance in your old superannuation, in your industry fund, if you had exclusions or some sort of changes to the policy. I think, and that would be key there. It'd also be, when you're switching, make sure you're aware of any costs of switching between those funds. So are there exit fees? Are there capital gains tax implications? And be completely aware before you make that decision.
That is one hell of a segue to our next question. Was that intentional? Did you mean to?
Yeah, I deliberately put these in order. Yeah,
beautiful, very smooth. I can't wait to see the next one.
V.
No. You can do the segues from now on for all of them. This one's Nurse Betty, hitching up the caravan. Would love a copy of Drew's book. No problem, Nurse Betty. We can make that.
Send through
happen.
Your address. We'll take care of that.
Hi guys. If you have an SMSF and an industry super fund, so there'd be two superannuation funds. When you retire, I believe you have to draw down a minimum percentage annually. What is the percentage? Also, do you have to withdraw the percentage from each fund? And can you contribute a portion of this total amount back into one of your superannuation funds? Well, I mean, from the top, yes, as you just said, yes, you can have more than one.
Yes, exactly.
Now, if we're talking about when you retire, you have to draw down a minimum percentage, that's not strictly true. If you set up a pension fund, then you have to draw down a minimum percentage. But if you chose to leave the money in accumulation, then you would not have to do that. Although admittedly, if you were to do that, if you were to do that, you'd be paying 15% tax instead of, in most cases, 0. So generally, if someone retires, we would say,
and they're over 60. Yeah, exactly. Yep. I think the key here is that so the minimum pensions are basically the trade-off that you get for when you commence that pension. You get basically a tax exemption up to a balance of $1.9 million in pension phase. So in return for that, you have to take out a minimum portion of your member balance every year. And this applies to every individual member account that you have in pension phase, which can be somewhat confusing when you have multiple super accounts in pension phase, and you always have to ensure you've commenced these and stayed under the $1.9 million cap. The minimums are based on the balance of your member balance or your super fund balance as of 1 July the previous year.
Of each pension fund.
Exactly. And they have to the trustee of each superannuation fund is responsible for ensuring that each member that is in pension phase for each super fund is drawing the minimum from their member balance within each pension, within each pension account. I said that 3 times just to make sure the message was clear. It starts this is one thing that we also find a lot of misunderstanding about for retirees is that it starts at 4% when you're under 65 years of age. It then goes 4, 5, 6, 7, 9, 11, 14. And the minimum increases initially every 10 years, then every 5 years. So you're actually forced to take more and more money out of superannuation as you age.
Yeah.
And the aim there being the government wants you to have more money outside of the tax exempt superannuation environment. So put simply, on 1 July every year, if you're already in pension phase, your super fund will write to you and give you an option of paying the minimum out of your fund or an amount higher than the minimum. In SMSFs, you'll also have a similar process, but you're usually doing the tax return yourself. So you'll have to make that election, but it is per member account and per superannuation fund. And in terms of contributions, if you're under the age of 75 and when you no longer need to meet a work test and you're under the total super balance cap of $1.9 million, you may be able to put those funds back into superannuation. But I think we've referred to the contribution caps in an earlier episode. Maybe we'll put that in the show notes as well.
Yeah, good call. Yeah. So yes, you could conceivably recycle that money. As a side note, I find it like the way that the balance goes, like as you said, up to 11%, up to 14%. So I think if you're 95 or more,
did I get them right?
You did. Yeah. If you're 95 or older, you've got to take 14% per annum. And it makes me wonder about who has had super the longest. Yeah, because you'd have to have scintillating returns in your 80s and 90s in order to be taking 9s and 11s and 14s every year and keep a balance. So there's some sort of world record there that I'd be very impressed to understand, but no one's been public enough to share that information yet.
Now I'm glad I get to ask you this question. So sent in by Scrooge Money Machine.
Good name.
This was the Scrooge McDuck, the old. I think it was also Scrooge Christmas. Yeah, but it's a perfect timing as we lead up or just after Christmas. He asks, are super funds overmanaged? Mm-hmm. I'm looking to invest for my kids as well as retirement for my wife and I. Mm-hmm. Why is it that a simple ETF can return 10 to 20% after fees, yet my super fund only returned 8.57%? Is it a case of 80% of fund managers not being able to beat the market?
Hello, Scrooge Money Machine. Thank you so much for your question, and really cool that you're looking to grow your wealth here. So a couple of things. We'll go from the top. A simple ETF can return 10 to 20% per annum, but that is not
50.
Yeah, but that is not the norm. Yeah. The norm is for most simple ETFs to be returning 10 to 12 in that sort of zone if they're fully invested.
Yeah, like the long-term return of the Australian share market and the global share market is like 10 to 11% per annum over 60, 70 years.
Yeah. So if we zoom out, I know that like if we're taking a lens of right now, there are super funds that are 60% up because of the wonderful economic outcomes that we've had, or market outcomes. But that's not the norm. You've got to zoom right out to take a longer term view.
These are abnormal returns for the last 4 years.
Very much so.
That.
Yeah, very much so. So firstly, if the first thing that I think this gap is likely to be for is not so much around the over management of super funds, but around asset allocation, because 8.5%, if you're using current numbers, it's very likely that money is invested in a balanced fund, which is the default. We have talked about this before. It is one of my biggest pet hates of the superannuation system is that a 38-year-old can have their money invested in a balanced allocation, which is 80% growth, 20% defensive assets, which essentially is going to earn 8 to 9% per annum, when in reality you've got 20 plus years of investment time frame here. It's just, as far as I'm concerned, it's just dead money. Now, the reason the super funds do that is because we know that we're going to have economic crises, and we know that most Australians are not very engaged with their super. And so most Australians will open that letter during that economic crisis that comes from their super fund and say, oh my God, I had $200,000 and I've now got $140,000. And of course, their phone lines go ballistic, and they find that really hard to manage.
You have to do it on the app now. You can't call a phone.
That's wise. Yeah, I can understand why. So because of that lower engagement, the solution that has been reached is that every super fund will err to the conservative side and invest a little bit more safely, so that when that economic crisis comes along, hopefully that 200K balance is only down at 160, or it's something where, from a behavioral finance perspective, people are likely to be a little bit less scared. So if you were to compare the two of these, I'd encourage, firstly, let's make sure we're comparing apples for apples, because your simple ETF that you're talking about is probably going to be an A200 or a VAS, or like it's going to be a pure equities play, for example, something like that, whereas your super fund is not necessarily like that.
I think one of the big things here is that, and it's reiterating that these are abnormal periods for market returns. And superannuation, these are pools of retirement capital in most cases, or for supporting retirement, and they want to be able to provide that income or growth in every environment. The problem with investing into single ETF is that if that market, so the Nikkei, the Australian share market even, essentially went nowhere for a period of 10 years, and you weren't getting 20% per annum, you were getting zero. If that's the case, do you want all of your retirement capital invested in that one asset class? So that's where the value of diversification and having multiple exposure to multiple markets. So if some of them do poorly, well, other ones are going to will hopefully do better. And I also think, and this is kind of a story of into active versus passive, which is if you're getting the 20% when the market goes up, you're also going to get the minus 40% that occurred during the pandemic, occurred during the GFC, on the minus 20% that seem to occur every 5 years, the minus 10% that occur every 18 months. So you're not just getting 10 to 20% every year. And I think that's incredibly, and it's something we do constantly at the moment, which is reiterating that the double-digit returns from a balanced portfolio, this is from a balanced portfolio, but from equity markets, you're getting like 20% plus returns, won't happen forever.
Yeah.
You go through any Vanguard or asset class chart and you'll see that sometimes equity markets are down 30, 40, 20, and they're not always the best performing.
Agreed.
So how do you pick the right ETF every single year? You can't.
Now, before we move on, one other thing to consider for anyone who's thinking a similar thing is around the reporting time frame. So, for example, like particularly over the last 4 or 5 months, we've had really, really strong returns, and ETF providers are pretty good at having close to live returns. Yeah. So you can say, what did my ETF do over the last 12 months, and you get all of that uplift. Yeah. Whereas we might be looking at a super fund that performed at 8.57 last financial year. Yeah. Doesn't include all of that uplift that we've had more recently. Again, timing is important here to make sure you're doing apples for apples. You've got a comment down the bottom though, Scrooge, which is around 80% of fund managers not being able to beat the market. That's not so much the issue because a huge amount of superannuation fund money is now invested in index allocations, especially as there's been this race to lower fees and people are so much more, Australians are rightfully so much more conscious of fees. That's really driven a huge amount more money to be invested passively. And so you'd be surprised at perhaps how much money is invested within an index portfolio or index allocations within your, for example, industry super funds and a lot of retail funds too. Yeah. But for people that want to geek out about that particular point of the question, if you Google SPIVA, S-P-I-V-A, you'll be taken to a website by a group called S&P Global. We'll include it in the show notes, but it is pretty amazing because it talks to the fact that it is true that the vast majority of actively managed funds, the vast majority across the planet, underperform the index alternative, which is a lower fee.
Maybe that's solution. A good topic for another episode.
Good call.
Active and passive, particularly around retirement.
Great call.
Super interesting because there are some parts of the active management that actually consistently outperform.
That's right.
That's always don't throw everyone in the same bucket.
Good
not
call.
That we are, not that you were, not attacking.
So
pro both.
That's definitely something that we can unpack a little bit later. Great suggestion, but we'll include it in the show notes too because it is quite fascinating to look through. The nature of index investing and how far that's come. Yeah,
for sure.
All right, doing okay. That's nice.
Well done.
We'll confirm that doing okay. Let's go through this. If I'm 62 and I've maxed my super contributions over 1.9 and I have $1 million outside super and want to retire, how should I plan to draw an income in retirement? Example, should I take it all from super, then go to super for a pension or half and half? Great question. Now, before we even jump into that question, we have to make our own assessment. Is this person doing okay? I would say they are.
I would say they are.
Okay. Yeah. So firstly, we validated the name that you've used. Well played.
I'll have two. There's kind of two high-level areas I'd look at here. Yep. I'm assuming from the question that you don't have a partner or your partner's in the same position. So the first thing you'd think about is, can you get money into your partner's superannuation account? If that was the case. The next one would be you have assets in multiple entity structures. So one thing I always look at and suggest is that you invest in the best asset classes for each entity. So if you've got a tax-free environment in superannuation, there'd be a tendency to prefer higher growth assets in that entity. And if you're investing in your own name or a trust or a company, you'd have lower, probably income focused and lower growth or assets that you can control the capital gains of. ETFs, managed funds, you just get distributed capital gains each year. Direct listed investments, in most cases, you can control when you're selling and realize the capital gain. So that would be the kind of high level. And essentially what you're saying is I'll assume you've commenced a pension, because commencing a pension with this balance over 60 is going to be saving you a lot in income tax every year. So that would be the first thing. So that would mean make sure you draw the minimum, as we answered earlier. Draw the minimum from your pension. But my advice would be general advice is always draw the minimum and draw no more than you need to, no more than the minimum. So make sure you're meeting your legislative requirement. And then given the tax benefits, regardless of the changes we've talked about, Div 296 in the past and different tax laws, you want to draw down as much of the personally held assets as you can more quickly than the superannuation assets. So the next step would be draw the income or start drawing the assets with the least tax implications from your personal portfolio. And then once that's exhausted, which if in this case, depending on how much income you're drawing, that will take some years, probably a decade or more, then turn to your accumulation balance as the next option. And that's because the tax rate in your personal name kicks in at 17% if you've got an income above 18,200, and then the tax rate in the accumulation phase is 15%. So essentially you're drawing it from the highest tax environment first and then going down to the next one.
Beautifully answered, mate. I have absolutely nothing to add.
Perfect.
So, pass. Let's move on to Wannabe Whale.
Yeah, this is a great one.
You want to?
I'll lead this one through. Could you run us through some of the pros and cons of someone in their late 50s, currently mortgage free, so well done, getting a $250,000 mortgage to use for non-concessional contributions to super, planning on retiring, drawing an account-based pension, thinking they could pay off the mortgage later on. The big question here, and probably most important one, is would the mortgage be tax deductible? And what's the worst case if you return to work in the next few years if you saw a significant fall in your assets? So, but that's a very specific part of the question. I'd just say, is it worth taking a loan secured against your property to contribute more to superannuation? And is there any tax benefit of doing so?
Cool question.
Probably should have led it that way.
I really love this is one of those out of the box or out of the square type questions. So really nice to get these coming through. So let's do the simplest bit, which is around the tax deduction. No, it will not be tax deductible, that loan. And the reason that it won't is because if you are taking out any loan, in order for it to be tax deductible, you need to be able to demonstrate that the nexus of the loan, the reason for borrowing the funds, is to produce income, to produce assessable income. And so for that reason, it's true that you would be producing income, but you wouldn't be producing it in your own personal name.
Not taxable,
and therefore it's not taxable in your name, and therefore it is not tax deductible. So similarly, there are some strategies around taking out not taking out debt and then investing that into an investment bond, for example. That because that's a different entity, it is not deriving assessable income for you. So unfortunately, it is not tax deductible. So we can start there. Now that we know that it is not tax deductible, what we're doing here is evaluating what kind of returns we would need to earn in order to offset the fact that you've got this non-deductible loan.
Yeah.
And non-deductible loans are really quite painful because we might look at today's interest rates of call it 6%, smidge more, but for a home loan, call it 6%. But bear in mind that if you're currently in your late 50s and I presume still working, then your tax rate is probably going to be at least 30%.
Yeah.
And what that means is that you need to earn, and not 6%, but 7.8%, or a little bit more, in order to have 30% taken off and be left with 6%
guaranteed return.
Return again,
yeah.
In order to clear that. Now, that's a pretty high hurdle to clear. Over the long term, if we talked before about superannuation and said if you're invested, or about like growth assets, if you're invested 100% into growth assets, you should be targeting that 10 to 12 long term if you're purely invested in equities. So if you are willing to take that risk and say, I'm going to shoot the moon here, I'm going to have a crack at just trying to grow this as aggressively as possible, then you could make a financial argument, ignoring the risk, that the cost that I'm going to incur in my super fund, or that I'm going to incur personally paying this debt, is less than the cost or the earnings that I'm going to get inside the super fund, and therefore I'm ahead.
Yeah.
The issue for mine is around the final part of the question. Worst case scenario, returning to work for 1 to 2 years if the market has a 20% fall. We have had, I guess this for me, there's a lot of recency bias here, and that happens for almost all investors. If we think about the most recent 20% fall that we had, was more than 20%, but it was during COVID. And we had this really sharp, pronounced fall as the world said, oh my God, what's going to happen as we grapple with this horrible virus? And the market fell, but then very quickly it went the opposite way and aggressively rebounded straight out of that. But if we go back to so there, yeah, you can say, look, 1 to 2 years, I was back out of it and profitable, but that is an exception. If we go back to the GFC and we look at the Australian market, we topped out 6,800 points in October 2007.
Yeah.
And for the market to return back to that level, including dividends, I think it was 2013, if I recall correctly.
Yeah.
But we had a 6-year lag for a high growth investment to get back to where it was. Yeah. And so that was a long period of time, but the truth is somewhere in the middle. The worst case scenario is that you're not returning to work for 1 to 2 years. The worst case scenario is that you might be underwater for 3 or 4 or 5 years if you had or longer if you had a really significant fall in investments. So for someone who's approaching retirement and considering retiring at 65 years away, we think about 250K, but hopefully we're getting let's say a 3% uplift on that money in terms of the difference between the borrowing costs and the aggressively invested money after tax. Yeah. Well, we're talking about $7,500 a year over 5 years is $35,000, smidge higher, 38.5. Like for me, is a 40K increase in my net wealth worth that risk? I'm a no.
Yeah, I think, and one thing I'd say here is that the question is kind of like trying to accelerate your savings in the later stages before you're in the lead up to retirement. It does reduce flexibility and increases risk. But one thing I'd suggest, maybe it's worth getting trying some online tools or getting some advice around what your super current balance is going to allow you to do in retirement. Maybe if there's some confidence around what level of income you can generate and for your capital to last, you might be less likely to. You might be more confident that you don't need to take on this mortgage and execute such an aggressive strategy as well.
Mm-hmm. Yep, very good. Again, love the question though, because the creative thinking around your finances is a really effective way of boosting your knowledge and also understanding what the possibilities are. So let's move on to Saint Nick. Now, this could be for a number of reasons. The first one is it could definitely be because of Christmas, because we're getting pretty close to Chrissy.
Yep.
But I don't think it is. I think this is a Nick Revolt fan.
I changed that name too.
So as a Saints fan myself, thank you, Nick Revolt, for asking the question. Oh, again, next time anonymise this, please, because otherwise it's a bit uncomfortable. The question is, not sure if it was your podcast, must be listening to too many.
Never.
But either Drew or James mentioned that you can transfer existing equities to your non-self-managed superannuation fund. Any idea if this is true and which funds allow it? I've drawn a blank with Mr. Google.
So what we're talking about here is an off-market transfer of shares. So you can transfer your best shares in CBA, Commonwealth Bank, I could transfer mine to you, I'd sell them to you off-market and do a transfer. You can do this, as the question suggests, to a self-managed super fund and quite easily. It is important to know, and I'll answer the rest of the question, that it is a capital gains tax event. When you're transferring from one entity to another, you will have to pay capital gains, and that will be a point at which it's been sold. It has been purchased or in some cases contributed to that superannuation account. Mm-hmm. The big one here is that, in my understanding, and unless it's in very limited circumstances for very few funds, you cannot transfer your existing equities into an industry super fund. You may be able to do it. I don't believe their member direct options allow that. But my understanding is that for most like Hub24, Net Wealth, these type of superannuation accounts, they will allow off-market transfers. Again, it's a capital gains tax event. But one of the kind of unique parts of superannuation is that once you've got a pension account, you can no longer add to the pension account. So this contribution or transfer could only occur into an accumulation account within a corporate superannuation plan or an SMSF.
Yep. Happy to
Got that
move
one.
on.
Perfect. Next question is from FI Seeker or Fee Seeker or FI Seeker. I'm guessing this might be fixed income, but let's just not try and read too much into that. And we'll anonymise this as much as possible. My Aussie share market portfolio outside of super is larger than my super balance. I'm maxing out concessional with dividends and turning 60 in 4 years' time. I'm not working anymore. Can I turn my existing super into a pension at 60 and still contribute into an accumulation account within my industry fund to add in later years? I'm looking at tax benefits doing so. And let's leave the stretch. There is a stretch question. I think that's probably going to be too specific and difficult to calculate. But the crux of this question is, can they turn their super into pension at 60 and keep contributing to an accumulation account somewhere else?
Absolutely, you can. And it can be a really, really effective strategy for a number of reasons. I mean, firstly, if you can turn your super into a pension at age 60, if you're able to do that, you'd be meeting what we call a condition of release. As a reminder, we've talked about that before, but the long and the short of that is that you would have to either retire or alternatively cease gainful employment after age 60 would allow you to meet a condition of release. And that can be as simple as just leaving one employer and starting at a new employer after the age of 60. That would allow you to set up a pension account, and then you can start taking tax-free pension payments from your pension account. It would also enable your pension fund to be taxed at 0% internally, which is marvelous. Firstly, it says you're not working anymore. So if you're over age 60, then yes, you would be able to do that from there. Now, you can also contribute into an accumulation account. The question is, why would you?
Yeah.
So if you are taking money out of the pension and then that money is getting recycled into an accumulation account one way or another, then from my mind's eye, you're taking money out of a tax-free environment and you're putting it into a taxable environment. And that approach doesn't make sense.
Yeah.
You still have the same, everything else primarily stays the same. If anything, you might end up with a worst case scenario in terms of taxable and tax-free contributions.
Yeah.
So for mine, unless you're taking the minimum pension payment and that minimum exceeds your cash flow, and so for example, you've got $2 million in your super fund at 60, you turn it into a pension. That's minimum pension is 4%. That's $80,000 a year, and your expenses are only $50,000, and you're left with this $30,000 that's just sitting there, or perhaps rental income is topping it. You just don't need the money. In that case, then absolutely putting it back into the pension or back into a super fund might make sense.
Yeah.
But you wouldn't take more than the minimum pension if you knew there was a surplus, because again, you're taking money out of a better environment to put it in an inferior environment.
I think that's, you'd probably ask me this one, but I think it's the exact kind of continuation of that, which is this question's been, is it worth selling shares from paying CGT and putting them into superannuation as non-concessional contribution? You've kind of answered that question as we've gone along from almost done, play on almost done. So that would be very much around this. The tax benefits of superannuation are significant, but realise that when you're paying CGT, you're reducing the amount of capital you can put in. So timing that appropriately in the lead up to retirement. I'm pretty sure I just asked myself
you asked
my
that
own
answer.
question.
Yeah, good. So
probably setting myself up for the next one.
The only exception to this, where you're taking money out of the pension phase and then putting it back into superannuation, the exception to that is when you can get a tax deduction for the contribution going back in. So let's imagine hypothetically that you are working and you've changed jobs at 60 years old and you've got $500,000 in super.
Yeah.
And from a cash flow perspective, things are pretty tight. You don't really have much more money to be able to get into super each year because you're paying off mortgages and all the other costs that life throws at us. In that scenario, there can be an advantage to turning on a pension account, which pays you, for simplicity, let's say $20,000 a year, and then putting that, you've got that $20,000 tax-free, and putting that $20,000 straight back into a super fund as a concessional contribution. If you're working, you might be, for example, earning $80,000 a year. That $20K that you've put in is tax deductible because you can claim a tax deduction for it as a concessional contribution. So essentially, the 15% tax you're going to pay on the way in is going to be is worth paying when you get a tax deduction at 30% on your own marginal tax rate. So that can be a very effective strategy as you transition to retirement, a very effective tax strategy. The laws have made that a little bit more difficult over time, but certainly if you're over 60 and still working and not able to contribute up to the caps, then this can be a pretty effective strategy for annual tax savings.
Yeah, for sure.
All right, Mr. Shoulda, Coulda, Woulda.
Yeah, I don't mind this one. Yeah.
Okay.
I set myself up for the most difficult question.
Explain yourselves about CBA. Love the opening. My father at 93 years of age has stuck to CBA like glue, despite the market poo-pooing it for quite some time.
Probably got CSL too.
Bought it at $5 and it's 300.
Yeah, exactly.
The market is not the economy. So what are the tangibles that have driven the growth and improving dividends? As the Drew Meister says,
it's a new nickname.
Growth plus income equals return. Over to you, Drew Meister. What are your thoughts here?
I mean, technically, income plus growth equals total return is the way we write it everywhere. I mean, this is me and Jamie, my business partner, have this conversation, and it's not an argument. It's just kind of yelling in different directions all day. And there's a big part of this question: what are the tangibles that have driven the growth and improving dividends? There are none. Like the business, I spoke to a group called Yarra Capital recently, and they talked about the fact that over the last 10 years, the valuation of the Australian banking sector has gone up $100 billion, and the level of profit that has increased from the banking sector over that period is $100 million. So they're making no more money than they did 10 years ago, but their valuation has increased. I'd have to suggest it's like a doubling of their valuation over that period. So no, there aren't any specific tangibles that have changed. And then interestingly, the other part of the question talks about dividends increasing significantly. But if you look back at 2015, the dividends were only marginally lower than they were just announced in 2024.
Yeah. And
that's like 9 years with I'd say no dividend growth if you consider that in 2020 and 2021, dividends were cut.
Yep.
So there's this conception that this company is performing exceptionally well from a business perspective is probably different to what's happening in the market. My view, and I've stated it openly multiple times, is that I'm not a seller of CBA. A lot of research has said it was, as we were talking off air as well, that the share price should be $100, and it's been $150 or close to for I think, or it continued to increase despite everyone having a sell on it for probably the last 3 years. There's a couple of underlying themes there that you need to be wary of, but understanding that there will be a catalyst at some point that means banks will be materially underperform or their valuations will switch. So I know you highlighted before that it trades on a price earnings ratio of 28 times the market.
Pretty close to. Yeah. With a long-term average for banks of 15.
And constantly called one of the most expensive banks in the world, like a price to book. So the value of its assets is, I think it was above 3 times, and most banks are like below 2. But this is CBA. I don't bank with CBA, sorry. But strongest brand, best balance sheet everywhere you look. Like the CBA really only lends to people who are able to repay even when things get tough, which is bad for the economy, but good for investors in CBA. And because of the brand strength and its history, so much of its loans are funded via deposits. So they got really cheap deposit funding in the form of term deposits and people holding cash accounts with them as well. And it's the highest that's where brand comes in. Noting, yes, I would buy CBA, and I'll ask you the question, would you buy CBA today? No. But I would only buy CBA and other banks and probably quite a few companies in Australia as part of a well-diversified portfolio. Everyone's going to say that it's going to fall, and there's enough people who are going to say it's going to keep going up. I'd suggest that potentially over the next 3 to 5 years, a larger portion of returns from CBA will come from dividends than earnings growth or than price earnings expansion, which we can discuss another episode, as have the last 10 years have basically been from valuation expansion, not earnings growth.
Yep. Yeah. Okay. Well, yeah, I'm not on the same page, but this is one of the wonderful things about investing is that
you can tell I like stocks
perspectives. Yeah. I can't. For me personally, I can't look past a price to earnings ratio of 28 and in a long term sector of 15. When we spoke about this before the show, you made a valid point, which is like, where's the driver coming?
Where's the buyer coming from?
Yeah. Where are we going to get that negative event where banks really slide? the Australian economy looks pretty strong right now. For a lot of really good reasons. It looks really resilient. I mean, it sucks because we have high mortgages as a result, but it is wonderful that we've got that level of resilience in the across the country. That said, I mean, if you're holding it, in fact, I can speak to this. We've got a member that we've recently divested, or we've sold some of it, just saying, okay, well, like we don't want this level of exposure because
as long as it's appropriately weighted is one of the other disclaimers you always put in there.
But I want to set a little bet with you, if I may. Let's have a side bet if you're brave enough. And I'm not even going to take the high road here. The current share price of the CBA is 158.
Yeah.
So
158. All right.
We'll take a 12-month bet.
12-month view.
Okay. Now I won't even, just being chivalrous, I won't even inflate this with just average ASX returns on the assumption that it continues to grow, which puts you in a great spot. In 12 months from today,
it'll be higher than a 158.
A good quality dinner, like I'm not talking about Vue de Monde or whatever, but just like a nice, enjoyable dinner with a couple of glasses of wine. The CBO is below 158 12 months from today.
I'll take that.
Okay.
I'll take that.
You're on.
Good luck, sir. To do that, Mon. Handshakes.
And
we're good.
Time for me to start my campaign.
There you go. He's going to start shorting it off air. And after answering the most difficult of questions, so we'll switch to the last question we've got for this week, which is, and I've played with the name here too. If it's just a single name, I'm always wary. So Leroy Brown, and there's a good old song.
Nice. Bad Leroy Brown.
I can't remember who sang it. It's like not Johnny Cash,
Frank Sinatra.
Oh, it was Sinatra. This is probably, and this relates to investment as well. So if you have an SMSF and retired, what strategy would you follow to sell shares or other investments, let's say shares, bonds, infrastructure, property, to ensure there's enough cash in the account for the pension to be paid? How would you decide which ones to sell to generate enough cash?
We have done this question a little while ago. We were talking about investing in retirement. And one of the things we spoke about there was around the composition of assets that you have as you move through retirement. One of the challenges that you'll have if you're not careful here is that the default, most people would typically say, oh, I want to leave my shares, I want to leave my exchange traded funds, like leave my growth assets. And they tend to do it for two reasons, but they're ultimately still creates the same problem. The first one is they're performing so well that I don't want to sell them, so I want to leave it there. And the second reason is they haven't performed very well, so I want to leave it there so that they have the time to rebound and come back. But sort of like all roads lead to, without much like careful thought, all roads lead to your overall investment portfolio being sold, of like getting rid of your defensive assets and it becoming gradually more and more aggressively invested.
Yeah.
So the first thing that stands out to me is that ideally you don't want to be selling growth assets. You don't want to be forced to sell them. Because that then creates a possibility of saying, well, I do need to take money out, and yes, the market's at a low, which it is, and I've just got to realize these losses because I don't have the time in the market. So that can be done a combination of typically having a heavier lean of selling defensive assets, but then also having sufficient defensive assets in there that if we did say, okay, the market has fallen, we're going to be waiting at least a couple of years for things to come back, there's enough cash there.
Yeah.
Now,
sure.
I think you guys have got a pretty good system around rebalancing portfolios too, if I understand this correctly.
Yeah, I think, and one of the things we talk about when we work with ongoing clients is that we're there to manage cash flow. There's a tendency when you're a DIY investor to worry about what dividend you're going to get from CBA or Telstra and determine how much you're going to spend based on the dividends you're getting. We say we're there to manage the cash flow. We'll always ensure there's enough money in the bank account. And how do we do it? It's all about rebalancing, and it's all about discipline around reviewing your portfolio. So every quarter, I'd suggest anyone doing it at home should do this as well. You should be reviewing your asset allocation and your investment weightings every quarter. Our first step is always, we've got an asset allocation with targeting which asset classes are now outside of that asset allocation range. That's where we'll be looking to sell or buy a portion, depending on the time. And if you're worried about cash being paid, then that would suggest the amount that your asset allocation is saying you should have cash will be below where it's supposed to be. In this case, global shares and Australian shares have done well for the last 3 years, so they're more likely to be overweight. They're overweight. Simply going back to strategic asset allocation moves money back into cash and ensures you've got enough for the next quarter, month, year, whatever it happens to be.
And taking profits off the table, right?
Exactly. We've found, and everyone says buy low, sell high. We've found the only way to do that consistently is by by having a quarterly or a consistent rebalancing and review process. The thing is, whenever I talk to people, it just sounds boring and conservative, but what we think it is prudent. And essentially, the risk of just letting your winners run is that you become more and more reliant on those. Your retirement then becomes more reliant on those as well. So it's all about consistency and reviews and viewing the same way that Buffett has probably thought about it forever. Don't just think about the income that's coming out, but think about the capital growth as something that you're able to spend as well.
Yeah, very good. I couldn't agree more. I think that that regular rebalance also, it takes some of that market timing away. If you do it annually, but then we forgot last year, so we've got to do it, like that's enough time that all of a sudden that these decisions
Everything
are complicated.
Yeah.
Whereas if it's consistent and regular and it's almost done, like the rule is that we do it. The exception is that for whatever reason, market-wise, we might defer, but the rule is that it gets done. You're going to have a lot more consistency around your portfolio.
And I think that's the perfect place to wrap up. This has been, I think you, hopefully, I always say hopefully you'll agree. These Q&As I feel are so enjoyable and valuable to understand what people are worried about and what people are questioning. So I keep encouraging people to send through as many questions as you like. We've got plenty to still go through in future episodes, but I really enjoy doing this one, and thanks for joining me again, James.
Oh, thank you. I got a free dinner out of this. No, a pleasure. Thank you so much, everyone, for keep asking those questions, because it really is a pleasure having the opportunity to answer them for you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.